Hi, and welcome to this screencast for F7 Financial Reporting. We're going to be talking about leases. IAS 17 is then the standard that governs this. And this is one of my favourite areas actually of the syllabus whenever I was learning it and I was doing this exam, just because I think it's a really good way, it has a good way of allowing you to get a good structure, doing out tables, and I find it quite easy to, pull out the information that the examiner's looking for whenever he's setting questions. So under this standard, there's two types of leases. There's a finance lease and there's an operating lease. So how do we establish what they are? Well, a finance lease is a lease that transfers all risks and rewards to the owner. So if you're thinking about maybe if you're leasing a car or leasing a piece of equipment, you're going to get the rewards as in, you can get from A to B, you have a nice car, you can make your product using the machine, but also you have the risk in that if something goes wrong to it, you're responsible for the maintenance and you're going to have to, take a hit for that cost. Another way to determine whether it's finance lease is the incidental ownership to the leasee. So this is basically, at the end of the lease, ownership transfers, or you can pay like a wee fee and then you'll get the ownership of that asset. So anything other than a finance lease is going to be an operating lease. So once you have, if you cannot pinpoint that it is a finance lease, then just immediately go to the operating lease and use that accounting treatment. So things that are going to be present in a question that you're going to be able to pick out and say, this indicates that this is a finance lease would be, do they get the ownership at the end of the lease? Do they have an option to buy at a, a nominal value or, a small price? And also, is the lease covering the major part of the economic life of that asset? And here we have this one, the fourth one down, PV of MLP approx FV. So what's this? This is just a shorthand version of is the present value of the minimum lease payments approximately the fair value of the asset. Another good indication that it's going to be a finance lease would basically be if it's a specialised item. So if it's a piece of machinery that's so specialised that not very many other people will be able to use it, it's a good indication that at the end of this lease, the leasee's probably going to keep it, and it's going to be of no further use. So that would determine that, the majority of the economic life of this is going to be used for this specialised use by, this company, for example. And is there any gains and losses with it? Are these going to the leasee? These are all indications of, a finance lease. So you would try and pick these out of the questions to try and back up your answer that you have said, this is a finance lease and this is how I'm going to treat it. Substance over legal form. This is touching on the issue of relevance outlined in the IASB framework. So basically, you need to be establishing whether or not the legal aspect, so, in this instance, the leasee doesn't actually own the asset. So should this be actually reflected in their balance sheets or their statement of financial position? This is whenever, legal form has taken over here and it hasn't really given a true reflection on what the actual economic reality is of this lease. So if you have a finance lease, you don't own it, but you're bringing it into your statement of financial position because the substance of this is basically it's your asset, you control it, you get all the benefits from it, and therefore you should be showing this in your financial statements. So you would record the asset in the statement of financial position, and then you would also record the corresponding liability broken down into your non-current liability and then your current liability for all your lease payments that you're going to have to be making over the time of that asset lease. So the initial recording, what you're going to be actually putting into your statement of financial position will be the fair value of the fair value or the present value of the minimum lease payments. So you'll again recognise that asset and the corresponding liability, splitting your liability into your current liability and your non-current liability. If you're categorising something as a finance lease and you have brought it in as an asset into your statement of financial position, another thing that you're going to have to remember to do is depreciate it. So just depreciate it like a normal asset. So, it's going to be depreciated over the shorter of the useful life of the asset or the lease term. Because obviously, if the lease term is going to be more than the useful life, you need to be ensuring that the depreciation is going to finish when that asset basically has been utilised that value has been used throughout that period of time. So the payments that you're going to be making, the payments you make every year, your lease payments, you'll be splitting into your finance charge, and then also you'll be reducing down that liability that you have established in your statement of financial position. So there's quite a few things that you need to be remembering to do. So you need to bring it into your statement of financial position as an asset and as a liability. You need to then remember that you're going to have your finance charge and your depreciation charge that you've calculated hitting the income statement each year, and you're also going to need to reduce the liability that's owed by the payments that you're going to be making yearly or monthly or whatever it is, whatever's specified in the question. So if it's an operating lease, you do not recognise the asset, there's no depreciation, and basically you hit the income statement with your charge, with the whatever payment you're going to be making for this asset, or whatever it is that you're leasing. This is a simple one, so quite often you'll find that the finance lease is obviously going to come up because there's a lot more calculations to do. But knowing, that there's operating lease is basically going to help you maybe argue each way, or perhaps there's various different, options open to the company, so they could finance it. They could lease an asset in one way, but then maybe in another way. So you maybe have to establish if the finance lease would be better, or if an operating lease would be better. So what is the difference? Why are we making such a big deal about categorising the finance lease and categorising the operating lease? Well, whenever we categorise our finance lease, we bring it into our accounts, show the asset and liability, charge the income statement with the payment that we're making, and also with depreciation. So if you maybe had a finance lease and didn't categorise it correctly, so you didn't recognise the asset, you didn't charge depreciation, etc., and you just brought it in as an operating lease, then your assets and your liabilities in your statement of financial position would be, your assets would be understated, and your liabilities would also be as well. So this is going to have an effect on your gearing and various other ratios. So basically it's not going to give a true reflection of the economic situation within your company. So if you just have the Kaplan text and you have a look at the Test Your Understanding 2 on page 278, it's really a good example on how you're going to be working out the finance lease charges and the liability in your statement of financial position. So I would give this question a try and try and establish, whenever you're reviewing the answer, you'll see this table, and this table is going to be key for answering any of the other questions. So here, you're breaking down that you have your year, the capital, so your fair value, which you're basically just plucking out from the question. So here we're told that the fair value is 69,738. So that's going to go in your first column. Capital brought forward from question, the fair value. The lease payment. This column is going here, and it's saying that the rentals are payable in advance. Now this is quite important because you need to deduct this from your capital brought forward in order to work out your finance charge. So I've just put a note at the bottom saying when the payments are made, you need to actually note this. If they're payable in advance, they reduce down your capital before the finance charge is applied, because if you're thinking about it, your finance charge maybe would be for the year. So if you are taking off your payment, you're reducing your liability that this percentage is charged on throughout the year. If they are maybe not paid in advance, so if it doesn't say they're paid in advance, you can take it out after the finance charge, as it's maybe going to be paid at the very end. So once you have your capital brought forward, less your lease payment, and then you apply your standard charge or your finance charge to that amount, you deduct that, or you add this as well, and it's going to have your capital at the year end. So this is going to be your financial statement liability. You then will split this into your current liability and your non-current liability. So you need to be thinking about what are the lease payments that I'm going to be making within a year, and that's going to be your current liability. And in this question, it's 20,000. So you need to deduct the 20,000 off the capital at the year end. This is going to be your current liability. The rest, so your balance, the capital at the year end less your 20,000, is basically going to be your non-current liabilities. So what hits the income statement then? You're going to have your depreciation, it's going to hit that, and also your lease payment, because basically, this is a charge, this is a cost, and you're basically going to just debit your income statement that. Well, I hope this was of some help to you, and please take my advice, learn these tables and learn how to plug in this information, do the test your understandings, and more importantly, do any questions that you can find in your study kit on leases to try and see what way the examiner could possibly ask finance leases, or show that the finance leases are, just to try and get your head around how to pick out information, so how to pick out your fair value, how to pick out your lease payments, and how to pick out your capital. So just in summary, we have our finance leases. Your finance lease is basically all the risks and rewards have been transferred to the leasee. You bring it into your statement of financial position as an asset and as a liability. You need to depreciate this. Do remember to depreciate this, because that's going to be extra marks that a lot of people would maybe just skip past because they would forget about it quite easily. So if you don't have a finance lease, everything else is an operating lease. And just another good thing to keep in mind is that land, even if you're saying that there's land and buildings together in a group within the question, land is always categorised as an operating lease and never a finance lease. So your operating lease is just a simple charge to the income statement, and you don't need to depreciate, and you do not need to bring it into the financial statements as an asset, as a liability, as you would have with your finance lease. Thanks very much.